Hello and welcome to IDFC First Bank presents Leaders of Tomorrow Season 11. I'm Sunanda Jayaseelan. On the show tonight, we're bringing you our SpringBoard series, conversations that we do pan-India with a live audience to connect better with you, the entrepreneur. Tonight, we're bringing you part 3 of our SpringBoard series from Chennai. I'm in conversation with none other than Sunil Subramaniam, someone who needs no introduction, talking to me about macroeconomic cues, talking to me about the markets. Should you be looking at IPOs if you're an entrepreneur, or should you not? Making and managing your wealth for entrepreneurs. He also fielded questions from our audience in Chennai. Listen. Thank you very much for joining us here this evening and for giving us your time, for which I'm sure you get paid for very handsomely every second. So this is a free session, let me assure you, on how you should be managing your wealth. Any questions you have, please keep those ready. Before we dive into how our entrepreneurs should be managing their wealth, what are some of the cues they should be looking at from the markets and the economy, I would love to understand how you got started in this space and in this industry. How do you manage your own wealth?
First, let me disabuse you of the notion that I'm paid so very handsomely, okay? But I think that my entry into this profession was because I wanted to be in Chennai. And the Sundaram group is headquartered in Chennai. So no rocket science. I was a banker in my previous life for 25 years before I came into the mutual fund industry. So I joined Sundaram Mutual because I wanted a job in Chennai. So that was it. And I didn't know much about investments before I joined. So as a banker, right, I was clueless about the markets. So just assuming that because you're in the financial services space, that you know about investments was the first notion that I had to understand. From then it's been a journey about the fact that in India, right, if you see a developing nation, right, the markets are always the best wealth creation tool because they are the source of financing the growth of the country. And so that's where you make your money from. So I think that.
So what tips would you want to give our entrepreneurs here today? If you had the top 4 or 5 tips, and like you said, you yourself had to learn about the markets. So from that experience and that journey, the top 4 tips or the top 3 tips you want to give our entrepreneurs who are making the wealth, but how to manage it?
So first thing I would say is that don't DIY. Do not do it yourselves. The markets are like a Formula 1 race, right? And the road is not like a Formula 1 road. It's a very rocky, bumpy road. If you're on your own, you're likely to get lost, you're likely to panic, you're not likely to stay. So I think the first thing is get an advisor. Get a financial advisor who understands it, because the main thing with the markets is that everybody shows long-term returns of the stock market and says, you know, fantastic wealth creation. Very few people have actually stayed long enough to enjoy that. And so how long do you stay and how do you do it? Right? There are enough financial advisors. I'm sure IDFC Bank has their wealth management arm, which can be a good financial advisor. Second, I would advise, and I think today the finance minister will also support it, I think ultimate wealth creation will happen only from equities, not from debt. Okay? Debt is a wealth protection tool, not a wealth creation or a wealth growing tool. So you are making money from your business, right? So debt will protect the wealth. So to the extent that you need to protect your wealth, debt is a good space to be in. But ultimately, you want to grow your wealth. And ultimately, investment or growing wealth is nothing but postponing consumption, right? You can buy a Merc today, you want to buy a Lamborghini tomorrow, right? That's what investors are going to help you, right? So in that context, equities is the one asset class that in a developing nation like ours, right, you should trust, right, from a perspective of that. Third aspect, the tip I would say is, having chosen equity, if you believe my thing and take that, volatility is your best friend. Pick the times when everybody is fearful, when there is high volatility, the more you allocate into that market at that time is when your wealth creation will be, right? So that's the third tip. The fourth tip is that with the help of the advisor, every single investment you make, right, barring none, write down what is the purpose of that investment. Every single one, right? Do not do that, because the biggest problem with most people's investment is they don't know when to redeem. When do I take the money out? So unless you specified a goal at the time of investing, then when that goal gets reached, ruthlessly redeem your money. Don't, at that time markets may look hot, it looks like it's the best time to invest, but no, don't forget that the day you invested, you had set yourself a goal. That goal isn't achieved, go and redeem. I think if you have just these four as the anchor points around your thing, I think you'll be.
Fantastic. Since you were talking equities, any specific sectors that in the mid to short term that are looking good, so that you want to
I
call
will
out?
definitely ask you to define mid to short term. You mean 3 hours to 6 hours?
Not market mid to short term. In the next 3 years to 10 years, and you have the central government which is talking about the Amrit Kal. What are these sectors that are going to really tie into this growth picture that we have?
So I would identify 3 sectors there, which all of which are going to present wonderful growth opportunities and wealth creating opportunities, right? The first, I would say, head and shoulders above everything else, right, is the manufacturing sector, the industry that you're a part of. Because if you see, manufacturing is just 15% of our GDP, right? But the kind of population that you have allowed to grow in our country, right, means that employment generation is the biggest challenge for any political government in power. The PLI scheme, and you mentioned the China Plus One opportunity, it means that this decade is going to be the decade of manufacturing. The government, through the PLI scheme, giving incentives, the need to create jobs. So manufacturing, I see going from, at least 15% to 21% of GDP. And so that's going to be the fastest growing sector of the economy. And that's where you're going to get capital market opportunities in the equity sector. The second sector, where you have to have a certain belief of trust that we will make it as a country, right? So if you then see, I see that our per capita income of about $2,300 would come to about $5,000, a little more than double by the end of the decade, right? Which means that people, as they go up the income chain, they spend less on the basic necessities and spend more on the autos and the house and the holidays and the Van Heusen and the Louis Phillips shirts. So discretionary consumption, I see as the fastest growing sector on the back of the manufacturing cycle, right? So I believe that discretionary consumption is again a bet. But overarching these two, I believe that sector, you will have periods when manufacturing is overvalued, doesn't deliver that return. Consumption is overvalued. The one sector which benefits from both manufacturing and discretionary consumption growth is banking and financial services. Right? So to me, that's got to be the permanent part of your allocation as a portfolio. You put your horses in these 3, right? I'm guarantee you that you'll be a winner in a decade's time.
Fantastic. Any questions anyone has? Can we have some mics passed around? Anything that you want to pick Mr. Subramaniam's brains on?
How do you see the interest rates? We have this traditional investments, which most people in India still, equity is one big investment opportunity. But if you look at the large base of India, still the traditional FD is what most people go to. How do you see that? We saw those decades where it was 12%, 14%, and now we are in the range of 6, 7. So how do you see it going forward?
I see that FD rates will be headed downwards. And the reasons for that, I would say, are 2, 3, right? So first is that I think the world, thanks to the Ukraine war, thanks to the Silicon Valley Bank crisis, thanks to the Credit Suisse default, is going to come to a stage where the US soon has to start cutting rates rather than continuing to rise rates. And India has to follow suit just to make sure the currency doesn't go out of whack. Forget about inflation. The reason that India has to either raise rates or drop rates is a function of the currency that we want to manage. So I see the US very soon. The markets, the Fed yesterday said they will start cutting rates by 24, but the markets are believing they will cut rates right from June. They don't believe the Fed. So I see the rate cycle then coming down to the world in a slowdown, and I see it coming down. I see for India also that because food is a key part of our inflation targeting, if you see the food supply, by and large, we are surplus on food. Yes, an El Nino risk is there for this year, but by and large, our food grain supply is very good on wheat, rice, everything. So to that extent, I see, and in a world recession, oil, we import 83% of our fuel, right, oil. So I see oil also trending down in a slowing down world. So the pressure on RBI to definitely cut rates is what I see coming through. The point I want to stress is that then when you look at it from an investment side perspective, right, there's the CPI inflation which is reported. There's a real inflation that you suffer. So at the rate of return, you will get 5, 6, 7% from your deposits. You're going to make negative real returns in a sense of your investment. Bank deposits serve the purpose of making sure you have assured returns and making sure you have liquidity when you need it. They are a very critical part of the system. But from a wealth perspective, right, I think India has to mature into having a wider investment portfolio.
It's time to slip into a short break on that note. Much more on the other side. Do stay tuned. We'll be back in just a moment. Welcome back. With us here on IDFC First Bank presents Leaders of Tomorrow Season 11. The finance bill will have an impact on equities as well?
No, I think it will be positive for equities because I think what it will do is to switch people into hybrid funds where they have specified today that 35% has to be the equity component. So a lot of money will now switch to 65% debt, 35% equity. So that kind of additional money coming into equity, that 35% will boost the equity markets. One. Second, it's positive for banking, so the banking stocks will go up and help the markets too. So I think that, no, I don't expect it to have a very long-term negative impact on the equity markets. But yes, the debt space definitely will be challenged in the coming.
Yes, go ahead.
What would be your suggestion in terms of allocation of our funds? I mean, I'm already thinking, though I started off with a certain budget that I would invest so much in the equities market for the next so many years now, but I'm already having second thoughts. While the property investments are giving a more certain and a more a feel-good return, when I see that with the equity markets, though yes, I've had good returns and but still it does not give that feel-good factor. So I want your suggestion with regard to how do we actually allocate and what should be the percentage of our wealth that goes into the equity market? If you can just give us some broad outline around it.
Is it an easy answer in terms of asset allocation? That's essentially the question, if I got it right.
Let me attempt it. The difference between property and equities is the difference between a hedge fund and a normal mutual fund. What do I mean by this? Most people leverage to invest in property, right? So when you leverage, automatically your returns look great because you put in less. And as long as the property market is appreciated higher than the cost of your borrowing, right? You will make that much more money because you're leveraged, but you don't do, right? Margin trading is for traders. You don't do margin investing. You don't borrow money to put in the equity market. So you're putting your absolute capital, one. Second is, property is a blind investment in the sense that it's an intuitive feeling for India's middle class and whatever, that property will always rise, and so you just buy it into it. It can't be a goal-based investment. You can't say, in 10 years' time, I want to take my whole family on a cruise to Switzerland, I need this much money, and I'll buy this property and sell it therefore to go there. Property is highly illiquid, it's not saleable if you want. But equities is saleable when you want, if you choose to. So I think from a goal-based planning perspective, right, property doesn't match with equity, right? So that's two. The third point about this is that property and equity both carry the ability to hedge you against inflation, right? Because companies benefit from inflation, commodity producers benefit, property prices generally keep pace with inflation. In a period when I'm talking about inflation being moderate and interest rates being lower, any financial assets would deliver better value than a real asset like property, right? That's a fundamental fact of the fact. If you see even housing allocations in India, 2014, there was 60% towards physical and 40% towards financial. Today that ratio has reversed to 60% financial and 40% physical because you've been through a moderation of inflation. So I think that factor, if India is going through, I think, a reasonably long period of moderate inflation, I wouldn't expect the property market to deliver that much as the equity markets, right? And simple fact of finally to come down to it, from your investable wealth, if you're talking about non-leveraged property investment, that is, you have 1 crore of rupees, you want to choose put equity or put in a property, right? Then your factor is that you are going to get rental yield from the commercial, you mentioned commercial, you're going to get rental yield, right? The moment that you're getting yield, you're taking away your appreciation as today's cash flows. Right? Whatever form and God, right? So it's your then decision of how much you need as cash flows to do whatever you want in your life. Whereas equity doesn't give you regular cash flows. So the very fundamental purpose of investing then becomes different. Real estate is actually a good substitute to fixed income because it keeps giving you rental yields. So it's a different asset class entirely. And finally, a simple thumb rule on equity is 100 minus your age. Should be your amount that you put into equity, right? So if you're 40 years old, 60% in equity. If you're 70 years old, you put 30% in equity. The rest you can choose. And like today, for me, real estate is actually an alternative to fixed income as an asset class. That's right. I did attempt.
Sure. Thank you so much for that. I saw somebody else had put up their hand there.
What's your take on gold as an asset class?
So first of all, gold is not an investment. It's an emotional reassurance. Okay, number one. Second is, India, though it's the largest consumer of gold in the world, through our own imports and through Switzerland, which takes that gold and then sends it to India. India is the largest. We don't decide gold prices, despite being the largest consumer, because gold today has changed from being an inflation hedge to being a dollar hedge. So gold's price movements today are decided by the sovereign wealth funds of the world. China with $3 trillion surplus, Norway with a couple of $1 trillion surplus, India with $500 billion surpluses are choosing, saying, do I put my country's money in gold versus the US dollar? And so if you want to look at gold as a tactical allocation, whenever you feel the dollar is going to decline, you add gold. When you feel the dollar is going to strengthen, you reduce gold. And I'll tell you the clue. I just mentioned a few minutes ago about what the market doesn't believe the Fed, right? The market believes that interest rates are going to go down. Today, go and take the gold charts. Gold has now become from 1 month to 3 years. Gold has become rising. Why? Because market thinks dollar is going to depreciate, right? Whereas when dollar appreciates, not only do you, a sovereign wealth fund makes money by the increase in the dollar value, but he's also getting the 3.5% return in cash flow, right? So gold, then to summarize, right? Because the world is going to go through a recessionary phase, I think there is going to be a sweet spot for gold for the next 3 to 5 years. Does it mean you go overboard? No. But I would say 5 to 10% of your allocation in gold, because gold, paper gold, is going to be no indexation benefit, which was there till there earlier. So to that extent, gold losses is seen as a paper gold. But I would say that as long as the world is going to go through a sold down until it comes back to a recovery stage, gold will give you decent returns. So have a decent 5 to 10% allocation of gold in your portfolio, purely as an investment decision, not as an emotional allocation.
All right, completely out of time then on this very special Springboard series from Chennai. We're going to 20 cities across the country this year on season 11. Where are we headed to next and how do you register for that? All of that information on our website. Details coming up on our screens as I speak. Thanks for watching. Have a good night.